Hello and welcome to another video of HKICPA financial reporting series, which is module 11. In this video, we will actually be discussing about HKS 38, which is on intangible assets. The document itself, the standard itself is very long. So this video will be only about what is an intangible asset and how intangible assets, how intangible assets might be reported on your financial statements, but we will see if we cover the later part. But more specifically, this video is going to be about what is an intangible asset, because that is important to understand in order to be able to record in company financial statements, namely balance sheet. All right, so let's get started. The objective of the standard, as it is written here, right? So it's about telling you or telling the companies the accounting treatment of intangible assets, right? And we are going to look at what intangible assets are, what is defined as intangible asset by this standard. Before we do that, we can actually look at the scope of the standard, which is important to understand, right? So what is not covered within this standard, right? So any intangible asset that are within the scope or within the scope of another standard, right? So that's this paragraph. Paragraph 13 actually tells you that there would be certain intangible assets which will be under the scope of another standard. So in other words, if that intangible asset is under the scope of another accounting standard, then the company is not going to follow HKS 38. Other standard is HKS 32 about financial assets, right? So for that, because financial assets, they can be intangible assets. Financial assets can be intangible assets. But they have a separate standards by themselves, right? So they have HKS 32, and therefore it's not going to be covered under HKS 38. Then HKFRS 6, which is about exploration for an evaluation of mineral resources. It's a separate standard. It's not going to be covered under the scope of HKS 38. Expenditure on development and extraction of minerals, oil, natural gas, and similar non-regenerative resources, right? So similar non-regenerative resources, because once you consume oil, you cannot generate, right? You have to dig out another oil, basically, right? So it's consumed. Similar like gas is the same thing. Let's look at paragraph 3, which is actually complementing paragraph 2A, basically above. So another standards, right? So for example, you can have intangible assets held by an entity for sale in ordinary course of business, right? So that will be covered under HKS 2 inventories. If you actually look at the standard by itself, if you just scroll up and go to the introduction section, you will actually find one of the reasons why the HKS 38 was introduced, or what changes were made. One of the changes in the definition was, in old definition, an intangible asset was something which was held for production or used for production. So it was it's counter argument to, like, it's counterintuitive because it's saying that an inventory can be intangible asset or long-term asset. So that's what it was trying to say. So it was confusing, and that's why it changed. But you can find more on that if you just scroll up to the sections in the introduction. But intangible assets which will be held by the entity for sale in the ordinary course, right, they would be actually in inventory. Then you have deferred taxes. Leases have its own separate standards, right? HKFRS 16. Then HKS 19, employee benefits, they have separate assets arising from employee benefits, right? That's a separate standard itself. So you have goodwill. Goodwill is actually, if you have to study consolidation as well, where you would actually learn about goodwill. So goodwill acquired in business combination, it would be under HKFRS 3, not HKS 38, right? So that's actually what it means by paragraph 2A, intangible assets that are within the scope of another standard. So all these items here are within the scope of another standard. So items in paragraph 3 are actually intangible assets that are within the scope of another standard. So that's what it actually means. Another example, a very good example that I would actually discuss in this video is here. Some intangible assets may be contained in or physical substance, right? So if you talk about intangible assets, what comes as a normal person, what comes into your mind is an intangible asset is an asset which doesn't have any physical substance, right? It's intangible, you cannot touch it. Whereas a tangible asset is something that you can touch, right? But you can have intangible asset on a tangible asset, right? So that's an example here that they have talked about here. So let's say you have a software on a compact disk, right? So you have a computer software on compact disk. How the company is going to treat that, whether it's entirely intangible asset or it's a hybrid asset, right? You can call it a hybrid asset. So what it says here in determining whether an asset that incorporates both tangible and intangible elements should be treated under HKAS 16 PPE or as an intangible asset under the standard, an entity uses judgment to assess which element is more significant, right? So what it means is that you will follow one standard only. You will follow one standard only. Right, so it's either going to be HKAS 16 or it's either going to be HKAS. It's either going to be HKAS 38. Right, so it's either HKAS 16 or either HKAS 38. Now the company needs to make estimates or make a judgment which component is more significant, and based on that, company will actually record that. So for example, computer software for computer control machine tool that cannot operate without a specific software is an integral part of the related hardware, and it is treated as PPE. The same applies to the operating system of the computer, right? When the software is not an integral part of the related hardware, computer software is treated as an intangible asset, right? So you will have to see, this is an example here that they have talked about. So you need to understand which component is more significant, right? So that was about paragraph 4. You can read other paragraphs that are not really difficult to understand. Let's look at some of the definitions that you will actually see, or the terms that will be there in the standard, right? So amortization is very similar to depreciation, right? So all I would say in here is like depreciation is for tangible assets, depreciation is for tangible assets, and amortization is for intangible assets. The amortization is for intangible assets, right? So that's what it is. That's simple amortization. Then you have a definition of asset, right? So if you look at the word intangible asset, right? So it's a combination of two words. Assets have their own definition in accounting, which is written here. So the company actually needs to meet the definition of asset and then the definition of intangible. And then there are some other criteria as well. So you see how hard it is for a company to record intangible assets on their financial statements. So accounting regulations sometimes can be very harsh. So let's look at what is an asset. An asset is a resource, right? So it's a resource which is controlled by an entity as a result of past events, right? So company has a control over that resource, and from, so it's word and not or, right? So both these should be met. Both of these should be met. Right? So from which future economic benefits are expected to flow to the entity, right? So the definition of asset is actually very simple, right? So the company should have control. The company should have control over the resource and future economic benefits, and the company will get future economic benefits, right? So that's what it is. That's what it's saying basically. Two things: control and future economic benefits. Then we have carrying amount. I don't think I would assume that you know what carrying amount is. It's simply the cost minus amortization in this case, or the depreciation, right? Which goes on to the financial statement, which is called balance sheet. And any impairment losses as well are also deducted from the carrying amount. Then you have cost, depreciable amount. So you can read these definitions if you want to, if you don't know, but I would assume that you should be familiar with these words, considering how far you are in your HKICPA journey. Then there's development. So development is the application of research findings or other knowledge to a plan or design for the production of new or substantially improved materials, right? So they're defining what is considered as development in this case, right? So if in your case study exam, if you look at this word development, it has its own accounting definition rather than interpreting this word in normal English, right? So that's why I say accounting, it's a language by its own. It has its own, it's written in English, but it has its own meaning. So you would need to understand what development in accounting means. It's basically, it means the application of research findings. So a company may have done research, right, for their products or anything. The application of it is basically development, the application of it, which will be used to actually, improve materials or improve products, right? So that's what development is. Then entity specific values, the present value of the cash flows an entity expects to arise from the continuing use of an asset and from its disposal at the end of its useful life, or expects to incur when settling a liability, right? So that's the definition of entity specific value. Fair value is just what you will get in the market, right? So a price that will be received to sell an asset or paid to transfer a liability in an orderly transaction. That's what between market participants, right? So that's what fair value definition is. Impairment loss is a decline in the value of asset, right? So the decline of value of asset compared to the carrying amount. So let's say, to give you a very simple example, let's say the cost of the asset was $10, but then you can only sell it for $9. So the impairment in this case is actually $1, right? So that's an example of impairment. That's an the market value of your product has gone down by $1. That's what an impairment is. Now, the most important definition in here is about intangible asset that you can actually see here. Intangible asset. So intangible asset is an identifiable non-monetary asset without physical substance, right? So it is it's important, it's non-monetary asset. It's non-monetary asset which doesn't have a physical substance. That's what an intangible asset is, right? So it's important to understand the definition of intangible asset. Then they have defined what is called the monetary asset. So if it doesn't meet this definition, then it's a non-monetary asset, right? So what is a monetary asset? A monetary asset is money held and assets to be received in fixed or determinable amounts of money, right? So that's what a monetary asset is, right? So these definitions here are actually, these two definitions are very important to understand for the standard. Then they have defined research as well. So you will actually in your exam, it's a very common question where they ask you about whether the company can capitalize research and development cost, right? So it comes under HKAS 38. Now there are certain criteria that must be met before company capitalizes those research and development costs, which of course is not the topic of this video. But if you would like to know more on this, please let me know in the comments down below so that I can make a video on that, right? So, but this video is only about what an intangible asset is and what are the basic definitions to understand intangible asset and how you can classify an intangible asset, right? So that's what the purpose of this video is. They have defined research. We can actually look at the definition. It's original and planned investigations undertaken with the prospect of gaining new scientific knowledge, right? So what company is trying to find out something, trying to figure out something, right? So to give you a very basic example, if you have a question in your mind and you're trying to search for something, right? So that's a research. Or maybe if you have lost your spectacles, right? So you search for them. It's not research, but of course that's the idea that you're trying to search for something new and original, right? So that's what research means here. The residual value of an intangible asset is an estimated amount that an entity would currently obtain from disposal of that. So residual value is basically, it's same thing as when you are disposing of your asset, right? So residual value is what you will get after you sell the asset, right? So sell the asset basically at the end of its useful life. That's what residual value basically means. They have defined useful life, right? So you can actually read what useful life is. Now they have you have paragraph 9 and 10 here, which I would say are important in understanding intangible assets. So intangible asset entities actually, they expend their resources or incur liabilities on the acquisition and development, maintenance or enhancement of intangible resources, right? So you know what intangible resources are. Intangible resources are basically as you saw above, they are non-monetary assets. They are non-monetary assets without physical substance, right? So that's what an intangible asset is. Right. So the intangible resources such as scientific, technical knowledge, design and implementation of new processes or systems, right? So anything, right? They have given you the examples there: intellectual property, market knowledge, trademarks. Anything which is non-monetary and doesn't have a physical substance is basically an intangible asset. Other common examples are computer software, patents, copyrights, motion picture films, right? Customer list. These are all intangible assets, right? So these are all intangible assets. For example, your health is an intangible asset to you. You cannot touch your health, but you can feel your health, right? So that's a common example. So you see how accounting is actually very practical at times. It applies to normal human life too. So your health is an intangible asset. So if you're healthy, it's an intangible asset to you. And then paragraph 10 is basically not all the items described in paragraph 9 meet the definition of an intangible asset, right? So again, as I said, you would have to look at the definition here. Not all of these above items here mentioned here are. So for example, customer list. Customer list is actually not shown in company balance sheets. It's never shown in company balance sheet. You may ask why that is the case. It's simply because customer list does not meet the criteria of intangible asset. It simply doesn't meet the criteria of intangible asset. And we will look at what is actually the criteria of intangible asset now. So the criteria is about identifiability, control over a resource, and existence of future economic benefits, right? So you say it has to, so this is the definition of an asset. This is the definition of an asset, right? So intangible asset has to meet the definition of asset, which is about having control and future economic benefits, right? Future economic benefits, and they should be identifiable as well. The intangible asset should be identifiable as well. This is the hard component. This is the hard part to satisfy. This is very difficult to satisfy. If an item within the scope of the standard does not meet the definition of an intangible asset, expenditure to acquire it or generate it internally is recognized as an expense when incurred, right? So it goes on to P&L. That's what it means. It goes on to P&L. It's an expense. It is going to reduce company's profit. That's the impact, right? That's the impact, and that's why you would see companies will try to figure out a way to record intangible assets on their balance sheets to make their accounting statements look good. Companies can do that. So if you want to pursue a career in fraud, you should actually be looking at these things, that whether the company has done anything like that or not, or whether company is trying to do that or not, right? So these would be actually some things that you can consider. So let's look at what is the definition of identifiability. Identifiability is an intangible asset requires an intangible assets to be identifiable to distinguish it from goodwill. So goodwill recognized in a business combination is an asset representing the future economic benefits arising from other assets acquired in a business combination that are not individually identified and separately recognized, right? The future economic benefits may result from synergy between the identifiable assets acquired or from assets that individually do not qualify for recognition. So this is the reason. This is the reason why companies can record goodwill from business combination. That's the reason right there. But what is an identifiable? This thing here in bold, paragraph 12 defines identifiability. So identifiability if it either, right? So it's either A or B, is separable, that is capable of being separated or divided from the entity, right? So it's a separate thing from the entity. It's a separate thing from the entity. It's not combined. So that's why customer list, customers cannot be separated from the entity. You cannot just separate it out, right? So, and identifiability is basically something that you can separate and is being capable of separate from the entity, sold, transferred, licensed, rented, or exchanged either individually or together with a related contract. Identifiable asset or liability, regardless of whether the entity intends to do so or not, right? And then or, so they have used or, not and in this case, right? So it's either, it has to be either A or B. So what is B? B is arises from contractual or other legal rights, regardless of whether those rights are transferable or separable from the entity or from other rights and obligations, right? So for example, goodwill from business combination actually arises from contractual other legal rights. But goodwill from business combination, HKS 38 is not applicable. HKS 38 is not applicable in this case because there is another standard for business combination, which is HKS 3. Right, so that's HKS. I think it's HKFRS 3. It's probably HKFRS 3, but you can actually look on that. So you can check which HKFRS is. It's business combination. They have their own separate standard over there, right? So that's the thing. Maybe let's see what is the standard for business combination, as it was discussed above. Actually, we can have should be correct over there. So it should be HKFRS 3, as I said. Yes, it should be HKFRS 3 because I remember HKS 3 is about something else. So business combination is HKFRS 3. Right. So that is actually about this video. We talked about what we talked about is the definition of intangible assets and the definition of identifiability. Then you have the definition of control here as well, because that's another important aspect, right? So company has to have control over resource and future economic benefits, as they have said here, right? So they have defined it here. The capacity of an entity to control the future economic benefits from intangible assets would normally stem from legal rights, right? So company should have legal rights over it that are enforceable in court of law. In the absence of legal rights, so it also, the accounting standard also tells you that if there's absence of legal rights, it is more difficult to demonstrate control, right? So you need to have, if you are claiming that you have control, then you should be able to demonstrate the enforceability. However, legal enforceability of a right is not a necessary condition for control, because an entity may be able to control the asset in another way, right? So you need to have support, or you need to have evidence that you have control over asset. Now, it's not necessary whether you have legal rights over it or not, but again, you would have to, company has to satisfy that. So market and technical knowledge may give rise to future economic benefits, and entity control those benefits if, for example, the knowledge is protected by legal rights, such as copyrights, a restraint of trade agreement where permitted, or by legal duty of employees to maintain confidentiality, right? So it's giving you an example. It's giving you an example on how it's not necessarily like for market or technical knowledge. Sometimes, you might be sharing your knowledge with others, right? So in that case, you may not have control. You may not have control over that knowledge. So you would have to. That's one of the reasons why people have copyrights, right? It explains. So then another example here that they have talked about is an entity may have a team of skilled staff and may be able to identify incremental staff skills leading to future economic benefits from training, right? So again, company employees are one of the assets of the company, but you never see employees on company's balance sheet, right? Why? Because they're walking assets. Employees can leave the organization at any point in time, right? Even though they may identify the identifiability criteria because they are separable, it's a separate human being that we are talking about, but it doesn't meet the definition of control over the resource, right? Companies don't have control over employees. One way to exercise control is by paying them so that you can, as an employee, then you might feel a little liable. But again, if you get a good opportunity, if an employee gets a good opportunity, they will tend to go towards that good opportunity, right? That's what it is. So the entity may also expect that staff will continue to make their skills available to the entity. However, an entity usually has insufficient control over the expected future economic benefits arising from a team of skilled staff and from training for these items to meet the definition of an intangible asset, right? So it's telling you why they cannot record employees on company balance sheet, right? So it's important. It's important to understand the definition of intangible assets before you go into the exam and you look at the case study. So as to just sum it up, an intangible asset should be non-monetary, without physical substance. That's what's the definition of intangible assets. Check for exceptions, right? So the scope, basically, you can refer to the scope of the standard in this case. Then it should be identifiable. And have control over the asset, right? Have control over assets. So these would be like the key takeaways in this case. From this video, actually, which is about what is an intangible asset? How do you define, how accounting standard defines intangible assets? I hope this video was helpful to you in understanding what intangible asset is. You should definitely give read to this accounting standard, and I will put the link below in the description box. If you like this video, please give it a thumbs up, and don't forget to share it with your friends and subscribe to my channel for more videos like these. And let me know if you would like to understand more on intangible assets, and then I can have another video on that where I can walk you through what research and development expenses are, because actually you do get a question on research and development expenses, whether the company can capitalize that or not. So let me know in the comments down below if you would like to make me a video on that. And thank you very much for watching this video. Thank you.